Imagine you're holding like a really nice, thick, premium leather wallet.
Okay, I'm picturing it.
Right. And you open it up, and sitting right there in plain sight is a crisp, perfectly real $100 bill.
Nice. Always a good find.
Exactly. But now, imagine you try to sell that wallet to someone on the street. The buyer looks at the $100 bill, looks at you, and says, I'll give you $60 for the whole thing.
Wait, what? Even though there's literally $100 of cash inside?
Exactly. You point that out. You say, look, there's $100 right here. And the buyer just nods and goes, yeah, I know. But I also know the guy who sold you that wallet is legally allowed to just, reach into your pocket and take $40 out of it whenever he wants to fund his cousin's failing restaurant.
Ah, so the market values your $100 bill at a massive discount.
Right. And today, we are going into a deep dive to explain the dark mathematics of how that exact scenario is entirely possible. But, on a multi-billion-dollar scale.
It's a cognitive gap that fundamentally shatters how most of us view modern capitalism. I mean, we assume financial markets are perfectly efficient machines, right?
Yeah.
That they price assets based on their literal value.
Right, the whole invisible hand thing.
Exactly. But when you introduce the mechanisms of ultimate corporate power, that standard math just completely breaks down.
Which brings us to the grand stage where this drama actually plays out.
Mm-hmm.
So think about one of the most modernized, technologically advanced industrial powerhouses on Earth.
South Korea.
South Korea. You see the glowing skylines of Seoul, the massive shipyards churning out freighters, the endless streams of vehicles shipping out globally.
Yeah, right. Practically every screen or memory chip you interact with has a root in that booming economy.
Right. And most people, if you just ask them, they assume this is the ultimate triumph of the free market. Perfect competition, disposed shareholders, just a booming capitalist success story.
But the reality check is staggering. When you lift the hood on this globally dominant economic engine, you find that a fraction of a percent of the population has essentially privatized the entire economic lifeblood of the nation.
A fraction of a percent. I mean, I was looking at an ownership map of the Hyundai Motor Group from around 2004, I think. And let me tell you, it does not look like a neat corporate flowchart.
No, it really doesn't.
It looks like a map of the human nervous system drawn by an absolute madman. Like you have arrows pointing everywhere, circular shareholdings, just dozens and dozens of shell companies.
Yeah, the complexity is intentional.
And huge percentages of the national GDP are generated within these tangled webs. Yet the control strings, they trace back to just a handful of individuals, a single family. These are the Chaebols.
Right. And to really grasp the gravity of this, you have to completely throw out the standard textbook model of what a corporation is, because the illusion here is public ownership.
The illusion.
Yeah, because, millions of retail investors participate in the stock market there. They buy shares of these famous blue chip companies thinking they're part owners.
Right, like they have a say.
Exactly. But the actual control, the absolute unquestionable final say on where every single dollar of profit goes, is entirely monopolized by the family.
Okay, but let me play devil's advocate for a second here.
Go for it.
If we're talking about a modern democracy, right, a highly developed nation, they have fair trade commissions, securities regulators, incredibly sophisticated institutional investors. How does a medieval style, royal family structure still dictate the flow of billions of dollars?
That is the perfect question, and that's exactly what this deep dive is all about.
Yeah, we're going to completely deconstruct the architecture of these massive empires.
Yeah.
We're going to uncover how they form, how they survive market panics, and most importantly, the hidden mathematical laws that govern how they expand.
Because once you understand the hidden architecture of these chaebols, you hold the ultimate blueprint for how capital truly flows, and not just in Asia, I mean globally. It is literally the physics of wealth concentration.
So to do this, we're pulling our insights from a monumental working paper. This was published by the National Bureau of Economic Research, the NBER.
Very prestigious.
Oh, absolutely. Yeah. The research team includes some heavy-hitting financial economists. We've got Almeida, Park, Subramaniam, and Wolfensohn. And I want to be clear, this is not some dry theoretical thought experiment where guys are just guessing at how billionaires operate behind closed doors?
No, not at all. This is a literal mathematical autopsy of power.
A mathematical autopsy. I love that phrase.
Well, it's true. For decades, economists stared at these massive corporate pyramids and just could not figure out why they formed the way they did. I mean, we knew the pyramids existed, obviously.
Right, you could see the legal structures.
Exactly. But the underlying, molecular mechanics of their growth, that remained a total black box.
And I really want to focus on how they cracked that black box. Because the researchers didn't just scrape public SEC filings or whatever. They got their hands on incredibly rare, granular data from the Korean Fair Trade Commission, the KFTC.
Yeah, the timing here is crucial.
Right, because this was following the Asian financial crisis in the late 1990s. And regulators essentially put a gun to the head of the top Chaebols. They forced them to report their complete ownership information from 1998 to 2004.
Every single hidden share, every internal link.
Every obscure private subsidiary buried 6 layers deep. The KFTC demanded the full map.
And that gave the researchers the raw material to actually prove, rather than just hypothesize, how power multiplies itself through equity. They revealed the exact algorithms of corporate control.
Okay, but before we get into those algorithms, we have to confront the traditional assumption about why complex corporate structures even exist in the first place. Because you hear this all the time in finance, right?
Oh, constantly.
The idea is that pyramids exist so rich families can just rob retail investors. I think the academic term is tunneling.
Yes, tunneling.
So the idea is that families build a pyramid of companies so they can siphon profits out of the businesses at the very bottom and then just pump that cash straight up to the top into their own private bank accounts.
Right. The assumption has always been that pyramids are inherently parasitic. The market views them as sophisticated theft mechanisms. They're designed specifically to hide the expropriation of minority shareholder wealth.
Right.
So if you see a company at the bottom of a pyramid, the traditional logic dictates that the controlling family is just going to bleed it dry.
Which is why investors usually run away screaming when they hear the word pyramid. They view them as massive black holes, but, and here is where the NBER paper delivers a massive face slap to this entire school of thought.
A total paradigm shift.
Yeah. The researchers propose a motivation that is completely counterintuitive.
They ask, what if these pyramids are not built to steal from the bottom?
Wait.
What if their primary architectural purpose is to build an impenetrable fortress around the family's most profitable assets so they never, ever have to share the red-hot returns?
Okay, let me make sure I'm grasping the scale of this pivot. You're saying they aren't hiding the gold at the bottom of the pyramid. They're keeping the gold at the very top, directly in their own pockets.
Yes.
And they're using the complex structure below to make everyone else pay for the bricks to build the rest of the empire.
You've hit on the exact mechanism. It is not about using convoluted structures to steal profits from garbage companies. It's about using complex structures to avoid sharing the profits of the absolute best companies.
Wow. That completely flips the entire script of corporate greed. I mean, it brings us to the core mystery the researchers set out to solve.
Right. How do they actually build it?
Exactly. Imagine a billionaire family decides it's time to conquer a brand new industry. Let's say they want to build a massive new microchip fabrication plant or like a global shipbuilding yard. How do they decide where to put it in the web?
It's a huge decision.
Yeah. Do they own this new company directly in their own name? Or do they bury it under 6 layers of shell companies?
To an outsider just looking at the corporate flowchart, it seems entirely random, just a chaotic mess of holding companies. But the researchers discovered it is a ruthlessly logical, cold-blooded calculation.
So the family essentially has 2 paths, right? Path 1 is direct ownership. The family just buys the shares of the new company themselves with their own money.
Right.
Path 2 is indirect ownership.
Right.
They use a company they already control to buy the new company. And that creates a new layer in the pyramid.
Exactly. And the decision between those 2 paths comes down to 2 specific variables: profitability and capital intensity.
Okay, break that down for me.
Sure. So the family models out how much money the new business is projected to make. That's profitability. And they model exactly how much upfront cash it needs just to survive the first few years. That's the capital intensity, or CapEx.
It sounds so deceptively simple when you put it like that. But to actually prove this was happening across thousands of companies, the researchers had to invent a completely new way of measuring corporate power.
They did, because amateurs just look at stock percentages.
Right? Like, you or I might pull up a financial terminal, look at a company, and say, oh, the controlling family owns 15% of the shares.
Right. But true experts ignore that surface-level number entirely. They look at 2 concepts: position and centrality.
Okay, let's strip away the intimidating jargon. When we talk about position, what are we actually measuring?
We are simply talking about distance. We're measuring exactly how many layers of corporate buffers sit between the ruling family up in their penthouse and the actual factory floor where the products are being made.
Right distance. I was actually looking at the methodology section of the paper, and they contrast their new algorithmic approach with the old way economists used to measure this. I think it was called the weakest link method.
Yes, the weakest link method.
Why was that old method so flawed?
Well, the weakest link method assumes corporate structures are straight linear chains.
Like a ladder.
Exactly. So if Company A owns 50% of Company B and Company B owns 30% of Company C, the weakest link to Company C is 30%. You just scan the chain and find the smallest number.
Makes sense on paper.
It does, but when you apply that elementary school math to a Chaebol, the entire model just shatters.
Because it is never a straight line. It's a web with 1,000 overlapping threads.
Right. Company A might own pieces of B, C, and D, and then D might own a piece of B. And in a true display of corporate madness, B might own a piece of A.
Wait, B owns A, but A owns B.
Yes. There are circular cross-shareholdings that literally loop back on themselves. So the weakest link method is useless. The researchers had to write an entirely new algorithmic model to trace the true flow of power.
How did that algorithm actually work in practice? Like, how do you mathematically track that?
Okay, imagine putting a microscopic, indestructible tracking device on one single dollar bill. And that dollar bill is paid out as a dividend by a factory at the absolute bottom of the web.
Okay, got my tracker on the dollar?
Now, the algorithm watches that dollar bounce upward. It gets paid to a holding company where it's split apart. 50 cents goes up to another holding company, 30 cents loops back around to a sister company, and 20 cents moves up to the next tier.
Wow.
The algorithm tracks every fraction of every cent until it finally lands in the personal bank account of the founding family. That is how they calculate the true position.
That is wild. So when they ran this tracking algorithm on the massive KFTC data set,
Yeah.
what did they discover about the actual distance between the family and the businesses?
The sheer depth of the structure is remarkable. They calculated something called the median position, and across thousands of companies evaluated in the study, the median position is 2.06.
2.06. Okay, let's translate that number into the real world. What does a 2.06 mean for the people actually working at these companies?
It means the ruling family almost never touches the actual factory, the actual product, or the actual service directly. A position of roughly 2 means that, on average, there are 1 or 2 massive, heavily capitalized buffer companies sitting directly between the family and the operational business.
So the family sits at position 1.
Right.
The massive buffer company is position 2. And the actual factory producing the goods is position 3.
Precisely.
You know, if you close your eyes and picture a corporate empire, you probably picture like a perfect sphere,
Yeah.
right? With the family acting as the glowing sun in the center. Or maybe you picture a tall, sturdy ladder.
Yeah, that's the standard mental model.
But the data paints a completely different picture. It is an incredibly top-heavy, upside-down triangle. The paper lays out a very clear 3-tier architecture that defines these empires.
The anatomy of a Chaebol is chillingly consistent once you map the distance. Let's start at the top. At the very top, layer position 1, you have the companies directly owned by the family.
These are the crown jewels.
Yes. They are usually the oldest, most foundational companies in the empire, often dating back to the family's original business ventures.
Okay, then we drop down to the middle layer, and the researchers call these the central firms.
Right. These central firms are the beating heart of the entire cable. They are massive in scale, and crucially, they are publicly traded, meaning regular retail investors own vast amounts of shares in them.
Right.
They're old, established, and they generate enormous, reliable rivers of cash. Think of the flagship corporate names that sponsor global sporting events.
Okay, so that's the middle. Finally, you reach the bottom layer, the pyramid firms.
The bottom of the web.
Yeah, these companies are buried deep in the dark. They have very high position scores because they're so far removed from the family. And the data shows they look completely different from those gleaming central firms.
Probably different.
They're usually very young, very small, and entirely privately held.
Yeah, and they do not own shares in anything else. They are the absolute end of the line in the corporate nervous system.
So, if I'm understanding this right, the middle layer is essentially the mothership. It's a massive dreadnought generating all the power, absorbing all the public investment capital. And the bottom layer is just a swarm of disposable drones being funded by the mothership.
That analogy perfectly captures the dynamic. The central firms in the middle layer are the engines of wealth generation. The family utilizes the cash generated by those engines to build and launch the drones at the bottom.
Which brings a fascinating new dimension into the equation, the element of time, the historical cycles of a corporation. Because logically, you would assume a billionaire family would want to hold on to their exciting brand new startups.
Right?
Like if they launch a fresh, innovative tech company with massive disruptive potential, you would think they want that right in their own pocket at position one.
Human intuition suggests exactly that, but the data reveals the absolute opposite behavior. The newest companies are the ones thrown mercilessly into the very bottom of the pyramid. Yes. The researchers found a massive negative correlation between a firm's age and its position within the web. The coefficient is -1.27.
Okay, translate that -is 1.27 into English for us.
It basically means that for every 15 years a company manages to survive and operate within the K-ball, it moves about zero point 0.2 positions closer to the family throne at the top.
So the old companies sit at the top and the new companies are banished to the bottom. Why does age determine power like that?
Because the Chaebol operates on a strict hierarchy of old money. Building a brand new company from scratch is an incredibly volatile endeavor. It consumes vast amounts of cash. It faces a high probability of total failure.
Right, startups fail all the time.
Exactly. And the ruling family simply refuses to take that asymmetric risk with their own personal wealth.
So they use the established old money to take the hit.
Precisely. They use the central firms to incubate the new businesses. The central firms provide the seed capital. They sign the loans. If the new drone company completely fails and goes bankrupt, the central firm absorbs the financial devastation. The family's personal bank account remains completely untouched.
But, and here's the kicker, the family still maintains absolute control over the new startup.
Yep.
Because they control the central firm that funded it. They get all the strategic control of the expansion without carrying a single ounce of the personal financial risk.
It is the ultimate asymmetry of corporate risk.
And this leads us to arguably the most shocking discovery in the entire paper. We're looking at why only poor kids enter the pyramid.
Poor kids.
Because the data proves that the companies relegated to the bottom of the pyramid, the disposable drones we talked about, have terrible profit margins. They just do not make good money.
Right. So let's revisit that traditional tunneling theory we mentioned earlier.
Yeah, the theft idea.
Right. The classic view argues that these drone companies are poor specifically because the family is stealing from them. The family is siphoning the cash up the pyramid, leaving the bottom companies hollowed out and financially ruined.
And I want to push back on the researchers here for a second, because as a skeptical reader, that tunneling theory makes perfect sense. If I buy a company and drain its bank accounts to buy myself a mega yacht, of course the company's going to look poor on paper.
It's a very logical assumption.
So how do the researchers claim that isn't what's happening?
This is where the researchers execute a brilliant statistical maneuver. They looked at the return on assets, the ROA, of these drone companies.
Okay.
But they didn't just look at their current profitability. They looked at the lagged ROA. They looked at how profitable the company was in the past, long before it was placed into its current buried position in the pyramid.
Oh, wow. And what did the data show?
The data revealed a massive predictive correlation. The coefficient was mega 0.303. It proves a phenomenon called the selection effect.
The selection effect.
Yeah. The family is essentially acting with extreme financial foresight. They evaluate a proposed new factory or a speculative venture. They run the internal numbers and realize this project is going to have terrible profit margins for the next decade. It is going to bleed cash.
So what do? Do they write a personal check to fund it?
Never. They completely refuse to use their own money. They pivot to the public central firms. They use the cash reserves inside those flagship companies to fund the highly questionable project.
They are deliberately shoving the poor kid down into the bottom of the pyramid.
Exactly. The family isn't making them poor by stealing from them. They were chosen to be at the bottom specifically because they were poor to begin with.
That is mind-blowing. It's like knowing a movie script is going to be a massive box office bomb, so you convince your friends to finance the production.
That's a great way to put it.
But if you have a script that is a guaranteed billion-dollar blockbuster, you mortgage your own house to fund it yourself so you don't have to share the royalties.
That is the exact profit motive driving the entire Chaebol structure. It forces us to ask whether these pyramids are a shield or an ATM, and the answer is Billionaires do not preserve their dynasty by risking their own cash on unproven ventures.
Which brings us to capital expenditures, or CapEx.
CapEx.
This is the physical cost of doing business.
Yeah.
Buying the heavy machinery, laying millions of miles of fiber optic cables, pouring the concrete for a shipyard. It's the expensive stuff.
And the researchers found a huge positive correlation between how much cash a company needs, its capex, and how deeply it is buried in the pyramid.
The coefficient was 0.344, right?
Yes. The more cash a business burns just to keep the lights on, the further down the pyramid it goes.
Just think about the scale of this leverage for a second.
Yeah.
If a project requires a literal mountain of cash to get off the ground, the family uses the pyramid structure to force minority shareholders to foot the bill. The everyday retail investors who bought stock in the central firm, thinking they were investing in a safe, blue-chip engine, are actually the ones paying for the risky new factory at the bottom.
The family leverages the central firm's public equity to expand the empire. But consider the inverse scenario.
Okay.
What happens if the family identifies a target company that is a high-profit, low-cost cash cow, a business that requires almost zero capex but generates phenomenal guaranteed returns?
Let me guess. The public shareholders do not get an invitation to that party.
Not a chance. They keep 100% of it. They place that golden goose directly at position 1. They bypass the central firms entirely.
Wow.
If it's a guaranteed winner that prints money, it goes straight to the family. If it's a risky cash-incinerating venture, it goes to the bottom of the pyramid, paid for by the public.
The structural genius of this is terrifying. I mean, it is entirely legal, yet it systematically transfers risk to the public while hoarding reward for the private family.
It really is.
But, I have to play the ultimate skeptic here, because causality is the hardest thing to prove in economics.
It is notoriously difficult.
How do we know the family didn't just take a bunch of good companies, put them in the pyramid, and ruin them through pure incompetence? Like maybe they just mismanaged them.
To definitively prove the selection effect over incompetence or tunneling, you have to find the death warrant before entry. You have to analyze the financial health of these companies before they ever cross paths with the Chaebol.
The pre-Chaebol data.
Exactly. Between 1998 and 2004, the researchers tracked 163 new companies that were acquired and absorbed into the various Chaebols.
Okay.
Because these companies existed as independent entities prior to the acquisition, the researchers had access to their uncorrupted independent financial records.
Oh, I see. They could look at the student's report card before they transferred to the new school.
Precisely. And the results were undeniable. Even before the family took control, a company's low profit margins mathematically predicted its future banishment to the bottom of the pyramid. The correlation was minus 1.131. It was so strong, it was essentially a predetermined fate.
Their destiny was sealed before they even signed the acquisition papers.
Yes. If an independent company was highly profitable, the family bought it directly and placed it at position 1. If the independent company was unprofitable and bleeding cash, the family orchestrated a maneuver where the central firms bought it, immediately shoving it into the deep pyramid.
This completely upends the traditional narrative of corporate power. Pyramids are not just crude mechanisms for theft. They are highly sophisticated risk quarantine zones.
That's exactly what they are.
The family is building an isolation ward around the bad, expensive, risky projects, and they're using public investor money to build the walls of the quarantine.
It is a structural mechanism engineered to cleanly sever risk from reward. The family reaps the concentrated reward of the prime assets, while the public absorbs the dispersed risk of the speculative ventures.
Which brings us to the inevitable consequence. The valuation trap, or as the paper calls it, the curse of the central firm.
The curse, yes.
Because if you're a retail investor listening to this, you might be realizing you are on the losing end of this equation. You buy shares in a massive, famous central firm because it has incredible revenues. You think you own a piece of a great business, but you are actually just serving as a limitless line of credit for the family's garbage side projects.
And this is where the broader stock market reacts. Investors, especially institutional ones, are not naive. They eventually identify the mechanics of the game.
The researchers analyzed the crown jewels of the Chaebols, the massive flagship companies that everyone knows, and they uncovered a glaring stock market puzzle. The stock prices of these central firms are inexplicably ridiculously low compared to the literal physical assets they hold on their balance sheets.
Right.
Why does the market value them so poorly?
The financial world calls this the Tobin's Q discount.
Okay, Tobin's Q.
Yeah, it's a crucial metric that compares the current market value of a company to the actual replacement value of its physical and financial assets.
So what it's worth on the stock market versus what its stuff is actually worth.
Exactly. A healthy, normally functioning company should have a Q ratio around 1, or even higher if it has strong growth potential. But the researchers discovered a severe negative correlation between a firm's centrality, how much of a mothership it is within the web, and its market valuation.
The coefficient was Medico 0.545, right?
Yes, it's the market's revenge.
Let's go back to our wallet analogy from the beginning. Regular investors look at these central firms and see the billions of dollars in cash they generate. They see the $100 bill in the wallet.
Right.
But they also see the ruling family holding the leash. They know with absolute mathematical certainty that the family's going to take that cash and use it to fund a terrible, low-profit drone factory at the bottom of the pyramid.
The market perfectly anticipates the future destruction of value. Minority shareholders understand they're going to be subjected to a hidden tax by the family to fund global expansion.
So they punish them.
Preemptively, they refuse to pay full price for the stock. They apply a massive permanent discount to account for the money the family is inevitably going to waste.
Let's make this abstract concept terrifyingly concrete. We need to do a deep dive case study into the shadow of SK Telecom.
Oh, this is a perfect example.
Because this discount isn't just a rounding error on a spreadsheet. It destroyed billions of dollars in paper wealth and triggered an international financial standoff. Imagine owning $4.4 billion in highly liquid assets, but the stock market decides your company is worth negative money.
It sounds like a glitch in the matrix, but it is exactly what happened to SK Corporation, the core holding company of the massive SK Group.
Set the scene for us. The year is 2003.
In 2003, SK Corporation is an absolute behemoth. Operationally, it is the largest oil refinery in Korea, generating massive revenues. But its true power lies in its position as a central firm.
The mothership.
Exactly. It holds gigantic stakes in other companies within the web. Specifically, it holds a 20% stake in SK Telecom, which is the undisputed king of the mobile telecom market in Korea.
And what was that worth?
That 20% stake alone is worth $13.6 billion on the open market.
Wait, let me run that math. 20% of $13.6 billion. That is over $2.7 billion in pure liquid asset value just sitting on SK Corporation's books.
And that is just one asset. It also holds a 39% stake in SK Networks, which was valued at $4.3 billion.
Okay, so that represents nearly another $1.7 billion.
Right. So between just those two equity stakes, SK Corporation is holding roughly $4.4 billion in highly valuable, easily sellable assets.
Any rational person would conclude that the market capitalization of SK Corporation must be astronomical. It should be at least $4.4 billion plus whatever the massive oil refinery itself is worth.
That is the logical assumption. But in December of 2003, the total market capitalization of SK Corporation hovered at a mere $2.9 billion.
I want the listener to really process that. They hold $4.4 billion in stock of other companies, but the entire entity is only worth $2.9 billion. That implies the stock market believes the actual functioning oil refinery part of the business is worth negative $1.5 billion.
Precisely. When you completely stripped out their debt obligations, their standalone operating value was effectively negative. Their standalone Tobin's Q was an abysmal 0.6.
Wow.
The market had discounted SK Corporation so heavily out of sheer terror of future pyramid investments by the family that it triggered a localized financial crisis.
The global investors literally believed that the family was going to take that $4.4 billion in pristine telecom assets, liquidate them, and light the cash on fire building terrible drone companies. So they priced the stock as if the money had already been incinerated.
Exactly. And this raises a critical operational question, you know? How does a massive conglomerate escape that kind of valuation trap?
Right, how do you fix it?
Well, in the case of SK Corporation, internal reform was impossible. An external force had to violently intervene. An activist investor group called the Sovereign Fund recognized this unbelievable, irrational discount.
And they moved in.
They aggressively stepped in, bought up almost 15% of SK Corporation, and essentially waged war on the controlling family.
They threatened hostile takeovers. They demanded boardroom accountability. They legally challenged the family's right to use the company as an ATM. And what happened to the stock price?
It skyrocketed.
Just like that.
Just like that. The moment the market realized the sovereign fund had the leverage to block the family from making any more bad pyramid investments, the massive discount began to evaporate.
That is the ultimate real-world proof.
It really is. It proves that the chronically low stock price was tied strictly and exclusively to the market's fear of the family's asset-stripping behavior.
If you're listening to this on your commute or at the gym, you might be thinking, wow, the Korean market in the early 2000s was like the Wild West. Good thing my modern index funds are safe.
Yeah, that's a common reaction.
But do not fool yourself into a false sense of security. This exact same leverage game is being played with your retirement funds right now across the globe.
This is emphatically not just a Korean story. It is a universal reality of capital accumulation.
The researchers make it very clear that this pyramidal structure is not some unique cultural anomaly isolated to East Asia. It is the natural, inevitable physics of extreme wealth.
Right. The paper cites a landmark 2002 study by economists Faccio and Lang. They conducted a massive mapping of corporate structures across Western Europe.
And what did they find?
They discovered the exact same architectural blueprints, from the historic multi-generational family dynasties in Italy and Germany to the sprawling modern conglomerates in India. They all follow the exact same family-controlled, pyramidal asset-stripping playbook.
It highlights the sheer inevitability of pyramids. As long as the legal system provides a framework to separate cash flow, meaning who actually receives the economic dividends, from voting rights, meaning who makes the rules and sits on the board of directors, pyramids will constantly be reborn.
It is the ultimate, perfected tool of capital leverage.
Let's synthesize all of these complex threads into a unified deep truth. Because if you truly understand the mechanics of the Chaebol, you understand the very essence of how earthly power operates.
That's a bold claim, but it's accurate.
How do you use the absolute smallest possible amount of your own personal money to exert control over the maximum amount of global resources?
It comes down to three foundational pillars that this NBER paper perfectly mapped out. The first pillar is the selection effect.
Keep the good kids in the mansion and throw the bad kids out into the cold pyramid. If a business venture is highly profitable and low cost, the family owns it directly. If it is a risky cash incinerator, they push it down the chain.
Exactly. And the second pillar is the financing advantage.
Pyramids are fundamentally a legal magic trick to expand your empire using other people's money. You use the retained earnings of the central firms, money that rightfully belongs to the public shareholders, to bankroll the new, highly speculative ventures.
And the third pillar is the valuation discount.
Because the free market is not blind. The public shareholders of the core central companies are the ones secretly paying the structural tax for the family's aggressive global expansion, and their stock prices are permanently crippled as a direct result.
So what does this mathematically proven reality mean for you, the listener? It means when you buy a supposedly safe blue chip stock, an index fund, or a piece of a famous global conglomerate, you have to look past the shiny corporate logo.
You really do.
You have to look at the underlying architecture of who is really holding the leash.
Because if we look at the macroeconomic trends of today, history is loudly repeating itself right now.
Think about the technological era we are living in right now.
We are looking at the explosion of artificial intelligence. We're looking at the transition to new energy, autonomous driving networks, massive next-generation semiconductor fabrication plants, and private space exploration.
All incredibly capital intensive.
Yes, these are industries that demand literally trillions of dollars in upfront capital. It takes billions of dollars just to train a single large language model. High capex, low initial profitability. Sound familiar?
It is the exact same high capital, high risk environment that burst the original cable pyramids decades ago. As transformative technology gets exponentially more expensive, capital is concentrating faster than ever before in human history.
So here's the provocative final thought we want to leave you with today. As we watch the shiny new tech giants in Silicon Valley, or the new titans of Asia, rapidly expand their empires, are they quietly building the exact same structural pyramids from the 1990s?
It's a question we have to ask.
Yeah.
We see legendary tech founders creating incredibly complex holding companies. We see opaque nonprofit boards controlling massive for-profit subsidiaries.
Right.
We see the proliferation of dual-class share structures, where founders hold near 0% of the economic risk, but maintain 100% of the voting power. Are we just watching the inevitable rebirth of the Chaebol, wrapped up in a shiny new algorithmic aesthetic and a modern PR campaign?
It makes you wonder, The next time you open your brokerage app and look at your carefully constructed stock portfolio, you have to ask yourself the hardest question in finance. Am I investing in the family's protected crown jewel, or am I just funding the disposable poor kid at the bottom of their pyramid?